Welcome to this session from the Skilled MBA Case Study Series, where we examine real-world private debt financing decisions. Today's case, Blue Owl Financing of Ping Identity, explores a high-stakes financial decision. Should Blue Owl Capital provide $875 million in debt financing for Thoma Bravo's acquisition of Ping Identity? This decision involved balancing risk, structuring investment safeguards, and evaluating return potential in the high-growth identity access management (IAM) sector. Let's analyze the strategic factors behind this financing decision. In fall 2022, Blue Owl was invited to provide $875 million in debt financing to support Thoma Bravo's acquisition of Ping Identity, a leading IAM software provider. Why this deal matters: major financing role in a high-profile private equity acquisition, potentially high returns, but with significant financial risks. Fast-growing cybersecurity market, yet Ping's cash flow remained weak. Blue Owl's investment committee had to determine if the risk-reward balance justified the transaction. Ping Identity operates in the identity access management (IAM) sector, a rapidly growing market driven by cybersecurity needs. Company overview: subscription-based model, recurring revenue from enterprise clients, expanding product portfolio, continually innovating in IAM technology, diverse customer base, serving financial, healthcare, and corporate sectors. Financial challenge: despite strong growth, Ping Identity had yet to achieve significant positive cash flow, raising concerns about debt repayment capacity. This created a complex financing challenge for Blue Owl. Several key stakeholders played crucial roles in this financing decision. Blue Owl Capital, evaluating investment risks and structuring debt financing. Ping Identity, seeking capital to support its private transition. Thoma Bravo, private equity firm acquiring Ping and managing long-term value creation. Investors, expecting high returns while managing downside risks. Aligning the interests of all stakeholders was key to structuring a successful deal. Blue Owl Capital faced three critical questions. Should they provide the full $875 million financing? Does the transaction structure sufficiently mitigate risk? Do the potential rewards justify the substantial financial exposure? This required a rigorous risk-return assessment. The deal had several strong positives. Growing market. The IAM sector is expanding due to cybersecurity demand. Recurring revenue model. Subscription-based business ensures stable income streams. Expanding customer base, increasing adoption across industries and geographies. Product innovation: Ping Identity continuously enhances its software capabilities. These factors support long-term revenue potential, but operational risks remain. Despite the strengths, several weaknesses created financing concerns. Cash flow limitations: no significant positive cash flow despite growth. High debt load: the financing structure added significant leverage. Pressure for rapid growth: expansion must be fast to justify valuation and repay debt. These risks made traditional financing structures challenging, requiring alternative approaches. The investment committee also analyzed opportunities and threats. Opportunities: strategic PE partnership, strong collaboration with Thoma Bravo. Cybersecurity growth: IAM sector demand expected to rise. Potential high returns if growth continues as projected. Threats: financial risk from high debt load, increased repayment pressure. Competition: rising competition in IAM solutions. Cash flow uncertainty: growth projections might not materialize as expected. Mitigating these threats required carefully structured financing terms. To evaluate the financing decision for Ping Identity, Blue Owl Capital applied several key investment principles. leverage and debt structuring, assessing how much debt the company can handle without financial distress, risk-adjusted returns, weighing potential profits against the risk of default and repayment challenges, cash flow coverage, ensuring Ping Identity's revenue growth can sustain loan payments, covenant protection, structuring the deal with financial safeguards to mitigate downside risk, market position and competitive landscape, evaluating Ping's long-term industry standing in the IAM sector. By applying these principles, Blue Owl aimed to structure a financing deal that maximized return while minimizing risk. The first option was to provide the full $875 million financing package, taking full exposure to the deal. Pros: high return potential. If Ping Identity grows as projected, Blue Owl earns strong interest income and potential equity upside. Strategic influence. Full financing gives Blue Owl leverage to negotiate favorable terms. Exclusive deal positioning strengthens Blue Owl's private debt market leadership. Cons: high exposure risk. If Ping struggles financially, Blue Owl faces substantial losses. Debt servicing concerns. Ping's weak cash flow raises repayment risks. Lack of risk diversification. Concentrating $875 million in a single company increases vulnerability. Key takeaway: while offering high returns, full financing exposes Blue Owl to significant credit risk. The second approach involved financing Ping Identity with strict financial safeguards, covenants, to reduce risk. Pros: risk mitigation. Debt terms would include cash flow triggers, minimum revenue thresholds, and interest coverage ratios. Stronger investor protection. If financial performance weakens, Blue Owl could enforce early repayment or renegotiation. Improved deal viability. More attractive to Blue Owl's investment committee due to built-in safety measures. Cons: limited upside. Stricter covenants may reduce Blue Owl's potential return. Negotiation complexity. Borrowers often resist restrictive debt terms. Potential early refinancing risk. If Ping performs well, it might refinance the debt at better terms, reducing Blue Owl's earnings. A third option was to co-invest in the debt financing with other lenders, reducing Blue Owl's exposure. Pros: risk diversification. Sharing financing with partners lowers Blue Owl's overall risk. Maintains industry presence. Blue Owl stays involved without overextending capital. Flexibility in future investments. Less capital tied to a single deal allows participation in other opportunities. Cons: reduced profitability. Sharing the deal lowers Blue Owl's total return potential. Less control over terms. With multiple lenders involved, structuring protections becomes complex. Longer negotiation timeline. Finding co-investors can delay deal execution. To assess the alternatives, Blue Owl used a risk-return framework. Alternative risk-level return potential, strategic fit. Full financing, high, medium protective covenants. Medium, high. High co-investment, low, medium, high. This case study highlights 4 key lessons in strategic debt financing. Risk management is essential. High-growth firms require structured safeguards. Deal structure matters. Protective covenants help control downside risk. Industry knowledge is critical. Understanding tech sector dynamics enhances investment decisions. Balancing risk and reward is key. Private debt investments must find the right equilibrium between exposure and potential gains. Based on this analysis, Blue Owl Capital should implement protective covenants, strengthen financing terms to reduce risk exposure, consider co-investment, share the financing burden with strategic partners, monitor financial performance closely, regularly track Ping Identity's cash flow and operational efficiency. By structuring the deal with safeguards, Blue Owl can maximize returns while mitigating financial risks. Thank you for joining this session of the Skilled MBA Case Study Series. We now open the floor for questions and discussion.